You know what's funny? The people we trust the most with our money usually tell us the least about how it really works. I learned this the hard way. Years ago, I walked into my bank thinking they were there to help me grow my money. The guy smiled, offered me tea, and pitched me this shiny savings plan. It sounded amazing until I realized later it was just amazing for the bank, not for me. And that's when it hit me. Banks aren't in the business of making you rich, they're in the business of making themselves rich. There are certain truths about money that they will never just sit you down and tell you. But once you know them, you can play the game differently and actually win. So let's talk about the 11 money truths your bank will never tell you. Money truth number 1. Your savings account is a great deal. For the bank, not you. Here's the thing. When you deposit money into your savings account, you probably imagine it's just sitting there, safe and untouched, waiting for you. But in reality, your bank is putting that money to work. They lend it out to other people, invest it, and make a return far higher than the tiny interest they give you. It's like you lend a friend $10,000 at 10% interest, but that friend only gives you back 2% and keeps the rest. That's basically what your savings account does. You might think, at least I'm earning something, but when inflation is higher than your interest rate, you're actually losing money without even realizing it. Banks love savings accounts because they get access to your cash for almost free. Let's say you've got $10,000 in savings earning 1% interest. That's $100 a year for you. Meanwhile, they lend that same $10,000 to someone at 8% interest and earn $800. You get $100, they keep $700. Multiply that by millions of customers, and you start to see why banks can afford those marble floors, free coffee machines, and fancy lobbies. Now, savings accounts aren't bad. They're perfect for your emergency fund or short-term goals. But if you keep all your money there, thinking it's safe and growing, you're basically letting your wealth shrink slowly. And trust me, the bank's not going to tell you that, because the longer you leave it there, the more money they make. Money truth number 2. Free banking services are never free. Ever seen those ads that say, 0 fees, 0 charges, 0 hassle? Sounds amazing, right? But the truth is, banks don't run charity programs. If they're giving you something for free, they're making that money back somewhere else. Think about it like those free mobile games. You download them without paying $1, but later you realize they're packed with in-app purchases and ads. That's how banks work. They might waive your account fees, but maybe they're earning from hidden charges on transactions, overdraft penalties, or low interest rates on your deposits. Here's a real-life example. A friend of mine signed up for a 0-fee credit card. No annual fee, no joining fee, seemed perfect. 6 months in, he missed a payment by just 1 day. Boom. Late fee, interest, and a penalty that cost more than any annual fee would have. Banks are masters at using free as bait. They get you comfortable, keep your money flowing through their system, and quietly collect revenue from other sources you don't think about. And the truth is, most people don't read the fine print, which is exactly what banks are counting on. So the next time you see free in banking, translate it in your head to paid for in a way I haven't noticed yet. Money truth number 3. Loans are designed to keep you paying, not to help you finish. When you take out a loan, whether it's for a house, car, or business, it feels like the bank is doing you a favor. Here's the money you need, just pay it back slowly. But the repayment structure isn't random. It's built to make sure they earn the maximum interest possible before you ever touch the principal. Let's take a home loan as an example. In the early years, most of your EMI goes towards paying interest, not the actual loan amount. So even if you've been paying for years, the principal barely moves. Imagine renting a car for 5 years, paying every month, and then realizing you've barely reduced the cost of owning it. Frustrating, right? That's exactly how many bank loans are structured. Why do they do this? Because the longer it takes you to pay off the principal, the more time they have to collect interest from you. And if you miss payments or need to extend your loan term, they win again. A friend of mine once refinanced his home loan to get a lower monthly payment. Sure, it reduced his short-term burden, but it also added years of extra interest payments. He ended up paying more in the long run than the house was worth. Banks won't say, "We prefer when you take longer to pay us back," but the math tells the story. The system works in their favor, and unless you understand how interest amortization works, you'll always be playing their game.
Money truth number 4. Credit cards are built to make you spend more. Credit cards are marketed as tools for financial freedom and building your credit score. And yes, they can be useful if you're disciplined, but the truth is, the bank's main goal is to keep you swiping as much as possible. They use rewards, cashback, and points as psychological triggers. Spend $500 and get 2,000 points. That sounds exciting, but most people end up spending more than they planned just to hit those reward milestones. And when you overspend, chances of carrying a balance increase, which means interest charges. And that's where the bank cashes in. Think of it like a casino giving you free chips. They know that once you're playing, you'll spend more than you planned. I've seen people chase rewards so aggressively, they ended up with huge balances they couldn't pay off in full, and the interest wiped out any free rewards they earned. Even the layout of your credit card statement is designed to protect the bank. They highlight the minimum payment in big, bold numbers because they know that if you only pay that, you'll be paying them interest for months, maybe years. So while a credit card can be a tool, it's like a sharp knife. Useful in the right hands, dangerous in the wrong ones. And banks are betting that most people will cut themselves just enough to keep paying interest without completely walking away. Money truth number 5. The financial advice you get from banks is sales in disguise. Walk into a bank and ask for financial advice, and you'll often be greeted by someone with a friendly smile, a professional tone, and a printed brochure. They'll walk you through the best options for your money. But here's the catch. Those options are usually the ones that make the bank the most money, not you. Think about it. A banker's job isn't just to serve customers, it's to meet sales targets. They have quotas for loans, insurance products, investment products, and credit cards. If you were selling shoes, you'd push the ones with the highest profit margin. In banking, it's the same. Only the shoes are mutual funds with high fees, insurance products you might not need, and fixed deposits that keep your money locked in. I once knew a guy who asked his bank for the safest investment for his retirement savings. They sold him a unit-linked insurance plan. On paper, it sounded perfect. Life cover plus investment returns. But the fees were so high that after 5 years, his returns were lower than a simple index fund. Why didn't they suggest the index fund? Because they didn't make much money from it. The thing to remember is banks are businesses. Their employees are trained to sell. So while some advice might genuinely help you, it's often wrapped in what's best for their bottom line. Always double check. Get a second opinion and ask yourself, if I were the bank, how would this product make me money? Truth number 6. The more accounts you have, the easier it is for them to trap you. Banks love it when you keep everything under their roof. Your savings account, credit card, home loan, investments, maybe even your insurance. They call it relationship banking. Sounds nice, right? In reality, it's a clever trap. When all your financial products are with one bank, it's harder to leave. Want to close your account? You'll have to untangle it from your loan repayments. Want to switch to a better investment option? You'll need to move your linked accounts. They make the process just complicated enough to make you think, I'll just leave it. A friend of mine had his salary account, car loan, and home loan with the same bank. When he wanted to refinance his home loan with another bank for a better rate, his original bank delayed the transfer by asking for unnecessary documents and verification steps. By the time it was approved, the special rate he wanted from the other bank had expired. It's like putting all your plants in the same pot. Sure, it's easy to water them, but if the soil goes bad, all your plants suffer. Banks know that once you're deeply tied to them, the hassle of moving is enough to keep you paying their rates, even if better options exist.
Money truth number 7. Special offers usually aren't that special. Ever notice how banks love throwing limited time offers at you? Things like extra 1% interest if you invest today, or zero processing fees for this month only. The goal isn't to give you a deal, it's to trigger urgency so you make a quick decision without doing too much research. One of the most common tricks is the introductory rate. You might see a credit card offering 0% interest for the first 6 months. Sounds amazing, right? But they know most people won't pay off the full balance in that time. Once the offer period ends, the regular interest rate kicks in, often much higher than average, and suddenly, you're paying a lot more. Same thing with loans. They might offer a slightly lower interest rate for the first year to hook you in, then increase it later when you're too deep in the repayment schedule to switch easily. A friend of mine fell for a zero processing fee home loan offer. What he didn't notice was the interest rate was 0.5% higher than other banks. Over the life of the loan, that tiny difference cost him far more than any processing fee ever would. It's like a store putting sale signs everywhere, but quietly raising prices before the discount. Banks count on the excitement of special to make you skip the fine print. Money truth number 8. Your loyalty doesn't earn you better deals. You might think that being a customer for 10 or 15 years means your bank values you more. Maybe they'll give you lower rates or waive certain fees. But in reality, loyalty rarely gets rewarded in banking. In fact, new customers often get better deals than existing ones. Why? Because banks spend more money attracting new customers than keeping old ones. That's why you'll see ads like special rate for first-time customers or exclusive bonus for new accounts. They assume existing customers won't leave because switching feels like a hassle. I knew someone who had been with the same bank for 18 years. When she asked for a small loan, they quoted her a higher interest rate than what they were offering new applicants. She confronted them, thinking it was a mistake. Nope, they just said, "That's the current offer for existing customers." She ended up switching banks and getting a better deal immediately. It's a bit like mobile service providers. They save their best offers for people coming from another network, not the ones who've been paying on time for years. Banks know the power of inertia, the human tendency to stick with what's familiar, and they use it to their advantage. Money truth number 9. Overdraft protection protects the bank, not you. Overdraft protection sounds helpful. We'll cover you if you don't have enough in your account. But what it really does is give the bank another opportunity to charge you fees and interest. Here's how it works. Let's say you swipe your card for $50, but only have $30 in your account. With overdraft protection, the bank will approve the transaction and cover the extra $20. Sounds nice, right? Except they'll then hit you with an overdraft fee, which can be $20, $30, sometimes more, plus interest until you pay it back. I knew a guy who thought his overdraft limit was basically extra cash he could dip into. He didn't realize that every time he used it, the bank charged him a fixed fee plus daily interest. Over a few months, he paid hundreds in fees for borrowing small amounts of money. And here's the kicker. Without overdraft protection, the transaction would have simply been declined and he would have paid nothing. Banks sell it as a safety net, but it's more like a fishing net that catches your mistakes and turns them into profit. Money truth number 10. Certificates of deposit aren't always the safest bet. In the US, a lot of people love certificates of deposits, or CD, because they feel safe, predictable, and guaranteed. You put in your money, lock it in for a set period, and you know exactly what return you'll get. But here's the hidden catch. Inflation. If your CD is paying 4% interest, but inflation is at 5%, your money's buying power is actually shrinking. You'll get your deposit back plus interest, but it won't stretch as far in the real world. Banks won't put that in the brochure because safe returns sounds much nicer than quietly losing value. And don't forget early withdrawal penalties. If you need your money before the CD matures, the bank will take a chunk of your interest, sometimes enough to wipe out most of your gains. I've seen people park emergency funds in CDs thinking it's smart, only to need the cash in a pinch and lose half the interest they'd ever earned. CDs can still be useful for short-term goals or part of a balanced portfolio, but putting all your money there just because it feels safe can slowly cost you more than you realize.
Money truth number 11. The bank's security measures are also about controlling you. Whenever you hear a bank talk about protecting your account or security measures, it sounds reassuring. Of course, we all want our money to be safe from fraud or theft, But what they don't mention is that many of these measures are also designed to keep you in their system and make it harder to move your money elsewhere. Think about how easy it is to deposit money into a bank. Instant, smooth, no questions asked. Now compare that to withdrawing a large amount or transferring it to another institution. Suddenly, you're asked for multiple IDs, written requests, sometimes even a waiting period. They say it's for your protection, but it's also about slowing down the outflow of funds. I remember a business owner who wanted to move a large chunk of his savings to an investment platform offering better returns. His bank insisted on in-person verification, delayed the transfer by several days, and kept calling to discuss alternatives. By the end of the week, he admitted he felt drained by the process. And that's exactly the point. Even features like daily withdrawal limits or holding deposits for verification are framed as safety features, but they double as tools for the bank to control cash flow. It's not just about stopping thieves, it's also about making sure your money stays in their system as long as possible. Security is important, no doubt, but never forget that in the banking world, protection can also mean restriction. The more hoops you have to jump through to move your own money, the more the bank benefits. So let's step back for a second. We've just peeled back the curtain on 11 things your bank will never openly tell you. From savings accounts that quietly shrink your money to loans designed to keep you paying forever. From free offers that aren't really free to loyalty that gets you nothing, to overdraft protection that protects them more than you, and all the way to those security measures that sometimes feel more like handcuffs than protection. And here's the thing, none of this is about hating banks. It's about finally understanding the rules of the game you've been playing all your life. Because when you know the rules, you stop being the easy target. You start asking better questions. You move your money with purpose, and you make choices that work for you, not just for them. Now, I'm going to be real with you. Most people will never hear these truths. They'll keep believing the polished brochures and smiling ads. But you're not most people anymore. You've got the inside view now. So here's my challenge for you. Don't just let this information sit in your head. Use it. Share it with someone you care about. Send them this video. Tag them. Because the more people know this stuff, the harder it becomes for the system to take advantage of them. And if you want more of these honest, no-fluff money talks that no bank or big institution will ever give you, hit that subscribe button right now. Make sure you like this video so YouTube knows to show it to more people who need it. Drop a comment and tell me which truth hit you the hardest. I read every single one. This isn't just another channel. This is your wake-up call in the world of money. And I promise you, the next video might just change the way you handle your finances forever.